Well, thanks for tuning into this conversation on BloombergQuint. I'm your host, Niraj Shah. Our guest today is Pinakin Parekh of JPMorgan. A few months ago, we did a conversation with him where we spoke about the really long-term view, a decadal view on resources in India and where would India stand with regards to them. We are today going to request him to talk about commodities at large and his views on the oil and gas space, and oil in particular, have been met with a lot of anticipation. So we thought it's best to get him to talk about these. Pinakin, great having you. I hope all is safe.
All is safe. Thank you, Niraj, for having me over here.
Pleasure is ours. Now, Pinakin, can you tell us the house view? You might well be echoing what your global experts think about oil. You might have your own thesis as well. Can you tell us, how do you reckon oil or crude oil will shape up over the course of the next 6 to 12 odd months?
Sure. Thanks, Niraj. So basically, JPMorgan has a strong research team across US and Europe covering the super majors and the commodity team which tracks oil. So there are essentially two parts to the oil story. The first is the near term, which is the next 6 to 12 months. Essentially, the view is that oil, unlike metals, is more driven by what happens in US and Europe. And over here, as US and Europe opens up, and more importantly, mobility increases, oil demand will increase from here. So in fact, our global teams are calling for a 4.6 million barrels of oil demand increase through the course of the summer, and oil demand hitting nearly 99 million barrels by the end of third quarter calendar year 21, which is as close to the pre-COVID levels as we have seen over the last few quarters or so. So oil demand will increase, and the increase will be driven by US and Europe, even as demand in Asia in general and India in particular remains weak because we are still coming out of the second phase. So in the near term, I think it's a very strong outlook for oil demand from here.
One belief that some experts have is that the current oil price scenario is pricing in the demand returning from US and continental Europe at large. Do your teams and you as well believe that not to be the case?
So our view is that oil prices could hit near $80 a barrel by the end of this year. We're already at $75 a barrel. So I think there are two forces over here at work. One is a near-term demand outlook, which remains very strong. And the second is the slightly medium-term outlook as to what happens to oil prices if supply were not to be able to catch up, given what's happening because of ESG, capital discipline. So you have both forces at play when it comes to oil prices at these levels.
But if hypothetically, Pinakin, and you understand this subject better, but if the OPEC plus cartel, and now it seems to be a lot more coordinated a cartel, if they were to open the spigots a lot more to take advantage of higher prices, could that bring supply slightly medium term? If Iranian oil comes into the market, could that bring about the necessary supply to just offset the demand push?
Sure. So when we are looking at oil prices, what our global team believes is that OPEC supply. So our view is that OPEC increases supply of another half of this starting from August, and that would bring the total OPEC plus to 2.4 million barrels of supply. Iranian barrels can possibly enter the markets, and overall, in the second half of the year, you can have another 1,000 barrels of Iranian. The demand surge that we are expecting of roughly over 4.5 million barrels, this should not be an issue, and it should be absorbed. The question is slightly medium term as to what happens if all the spare OPEC capacity gets utilized and the global majors are either not willing to or not able to invest in new capacity creation.
Okay. Now, I guess I did not read it wrongly, but did you? I believe you put out a note saying that oil upstream in India is at a place where metals were a few quarters ago, in that people didn't believe in the story. The prices of the base commodity were moving up, not enough capacity is created, and therefore you believed maybe that there is a series of upgrades up in store over the course of the next few quarters. Did I get that correct?
Yes, Niraj. So basically, go back to 2020, second half of the year. Basically, steel prices had just started rising, and the belief was that China is not going to drive demand, and hence these commodity prices are not sustainable. And hence investors did not buy metals in the initial leg of the rally. And as the commodity prices moved higher, there was more demand visibility, the flow through to equities happened. When we talk to investors, we see a similar sense on oil. In fact, our global team did publish a report on the feedback on the super cycle. And their view was that investors generally believe that, look, oil demand is not going to sustain, oil supply is going to surge, and maybe oil prices cannot sustain at these levels. So you have a similar backdrop. There is a lack of belief or trust in the commodity price itself. And hence, investors don't want to look at the commodity equity, which in this case will be the upstream companies.
And of course, you believe to the counter. Now, my question is your, I'm taking that you are positive on upstream companies as a sell-side analyst. Is your hypothesis or is your optimism based on oil prices hovering at the current levels, or oil prices reaching a particular level and sustaining there?
Sure. So to give you a sense, our earnings assumptions and our stock prices are based on oil prices actually slightly lower than current levels. But oil prices are actually much higher than what, if you look at consensus earnings estimates for these stocks are. The difference is that while consensus believes oil prices to fall back from here very sharply, the fundamentals suggest that oil actually could move higher from here, at least in the near term. And there is an upside risk to the medium term if the underinvestment theme in oil capex plays out as what the initial signs are suggesting.
Okay. Now, viewers, remember, we are not going to be talking stocks here. Pinakin, if by mistake also, if I ask you about a stock, just feel free to tell me that you can't talk about it. Yeah, it may just come up in the realms of the conversation.
Sure.
But my question, therefore, is the skeptics to the theory talk about how the capacities of the upstream companies are not modern enough. They're creaking they're bursting apart at the seams, so to say, creaking under the kind of usage that they have. And there is the gas bogey, which hampers the overall earnings down as well. How would you respond to this?
So basically, there are two parts. At the end of the day, commodity company is earnings are driven by price and not so much by volume. So if you take any upstream company globally and you plug in a $25 oil, you are going to get a very different earnings outlook. Yes, companies may not have volume growth, but they still will get the full benefit of higher crude prices. Secondly, when it comes to gas, now what has happened is because crude prices are surging, you are also seeing global gas prices rise. In fact, global LNG prices are also at multi-year highs. Global gas prices tend to be linked to Brent-linked contracts. So as Brent prices rise, so do gas prices as well. And when it comes to Indian gas prices, there is a lead and lag in terms of pricing. So the Indian government follows the formula is around a 6-month lag. But you will have gas prices also, which will increase from here over the course of the next 12 months or so. So the entire energy basket, and it's not only oil, it's oil, gas, coal, is moving higher. I mean, they were a lagged play, but it's finally coming through.
Yeah, actually, I did see a note from you, I believe, on Coal India as well, if I'm not wrong, or coal rather, not Coal India, excuse me. Maybe on Coal India too, but I remember seeing a note on coal. Just a quick couple of follow-ups there before I move base to metals as well. I would love to hear some thoughts there. You would have seen so many of these previous cycles as well. Is this in any fashion similar to any of the previous cycles? And do you reckon, you kind of written it in the note, but I would love to hear from you. Do you reckon that it's not just the investor, but the street at large underappreciating the force with which the crude uptick and thereby the earnings uptick of these upstream companies would be like? I mean, my sense, the sense that I'm trying to get is a lot of people are now starting to talk about higher crude prices, but the street underappreciating the force with which these earnings could turn around because of the base commodity being higher.
Sure. So there are two parts to it. One is that the street's view is that, look, we have seen this in oil multiple times. In the last 6-7 years, oil follows a boom cycle of 18 months. Prices hit $75-80 a barrel. you have a surge in supply from US shale and prices fall back to $40 a barrel. So this has happened 3 times over the last 6 years or so. And that is the general consensus thought process that, look, higher oil prices will attract higher supply. The difference this time versus the previous 2 or 3 happenings is that shale is very clearly focused on capital discipline. And in fact, the JPMorgan global team expects US oil supply to increase by just around 0.6 million barrels, shale being disciplined. And the second is the lack of investment by the global oil majors on new capacity. And this is not something which will, flip over the next 12 to 18 months. There are issues over there in terms of ESG, which is asking for non-oil investment. So this time, higher oil prices may not attract the same level of supply growth which we have traditionally seen, which means that oil prices could be higher for longer, which at this point of time, obviously, the stocks are not pricing in and neither are the investors, and which is where the big positive inflection could be.
Last question on this topic, Pinakin. In case the unthinkable happens, unthinkable right now as per you, but let's assume for whatever reason, in some fashion or the other, oil prices, yes, they move up from here, but they don't have a surging kind of a move. They move quietly, settle down at slightly higher levels, and then in some fashion or the other, because of supply or other reasons, let's assume for hypothesis that they then start drifting lower, not crack, but drifting lower a bit. The point that I'm trying to get at is that a lot of times equities would move due to sentiment and not necessarily just due to underlying earnings. What happens if the accompanying uptick in earnings, because I heard you say that your hypothesis is based on slightly lower crude prices, so earnings growth will happen irrespective of whether crude prices are here or they're at higher levels. But what happens if the period of the higher earnings growth for the upstream companies is accompanied by a slightly lowering down of sentiment on the outlook on crude prices? Do you reckon that still there could be a case of upgrade simply because the valuations currently are at a significant discount?
Sure. So this, I think what we can see is what we are seeing in metals right now. We, in fact, recently had a sector piece on commodities in metals where we said that, look, we are entering a period of consolidation. So if you have a range-bound commodity price environment, right, where it settles down in a range, stocks will also consolidate. But I don't think the stocks generally crack and, it's the end of the trade. Because if the commodity prices after moving X percentage higher settles at that levels, you will have a new set of investors who will enter these stocks simply because they have more visibility. What you don't want is a very high degree of volatility in any commodity. You don't want commodity prices to go up 20% and then fall 20%, because then that just keeps the investor out from the stocks.
Got it. But you do reckon that because the upstream companies are nowhere close to where the metal company valuations are right now, even in a consolidation phase for the commodity, the valuations are still in favor for the upstream companies.
Yes, very much so.
Got it. Okay. Can I just shift tracks a bit and talk about metals, because that's such a big thing right now and an enigma of sorts, Pinakin, especially after what China announced day before yesterday. How material is that argument?
I mean, what the JPMorgan China colleagues highlight is that at the end of the day, there is only limited what China can do in terms of talking down prices. What they highlight is the impact of what the China had seen in cement prices, and they had tried to have controls and try to talk it down, but that was not met with success. What do they, however, highlight is that China is the seasonally weak period for demand. The monsoon season impacts construction, impact commodity demand, and hence you might see a slowdown in demand, but that's seasonal in nature. In terms of release of reserves, in terms of talking down prices, it should not lead to a crash in commodity prices unless we have a very sharp decline in demand. But seasonally, demand will weaken.
We're actually making a point out here that the dragon may not have the right clause to bring down prices just via talk. Even if they release state reserves, it may not really materially impact prices.
So what we would highlight is that instead of something leading to a price crash, right? What we are highlighting is that if you look at the physical demand supply in commodities, demand is very, very strong at this point of time in China. So as seasonally demand cools off, you should see some of these prices pull back from here. That seasonal demand weakness in some of the commodities could be visible. Beyond that, we need to wait and see as to how the supply side moves inside of China related to various commodities.
Okay. Last couple of questions on this conversation, Pinakin.
Sure.
There is, how do I say, a clear divide in the minds of the street between ferrous and non-ferrous. One on the side of the demand that is there, that could be there, and two on the side of the valuation that could be there. And of course, the underlying balance sheet strength that suddenly the steel companies have had because of the deleveraging, at least in India. Could you tell us what your view is out here at the current juncture?
Sure. So what we believe is that ferrous, particularly steel, has a structural tailwind driven by China's decarbonization. As we had highlighted a couple of months back, if you have a situation where China exports less steel and India's steel demand surges, you normally should see higher steel prices and higher steel spreads. Whether current steel prices are sustainable or not, that time will say. But steel has a bigger structural tailwind compared to some of the other non-ferrous metals, simply because China is the largest exporter of steel in the world. And as that supply reduces, it creates a favorable backdrop for prices.
So volumes don't materially get bogged down because of the whole infrastructure push and the cranking up of the GDPs across the world as our planet recovers, and pricing doesn't crack down too much either.
Yes. That broadly will be.
And last question then, therefore.
Sure.
In this cycle that we are seeing for commodities, because Indian steel makers have deleveraged their balance sheets, would you believe there is an argument for, because ROEs don't go down to near zero or at the numbers that they have in the previous cycles, that the average multiples that you would be comfortable assigning to these steel companies, or indeed even non-ferrous, might be higher than normal, and therefore is that a net positive?
So this is something that time would tell whether investors are willing to re-rate companies from what we have been seeing over the last 10 years. That will be a function of where is a new normal for commodity prices? Do prices settle at much higher than average levels? How do companies use the balance sheet strength? Do we see increased payouts, more judicious capex, and hence higher ROEs? If you have these flow through, then always there's a case for re-rating. In fact, we have talked about some of the companies in our coverage where there is a case for re-rating, simply because earnings will settle at a higher level and the balance sheets are much better. Whether it's across the board or not, that's difficult to say. Company to company, it is possible.
And this is not just in steel, but in non-ferrous as well, or it's only for ferrous you're saying right now?
So at this point of time, instead of, we don't make that distinction between ferrous and non-ferrous. We look at bottoms up in terms of what the companies are doing and how that can lead to a higher multiple.
Okay, great. Pinakin, this was lovely talking to you today. Thank you so much for being with us and giving us a sense of this whole commodity basket.
Sure. Thank you. Thank you for having me over here, Niraj.
The pleasure was ours. And viewers, thanks for tuning into this conversation.
Sure.